Welcome to the Emerging Manager Spotlight. I'm John Gannon from Venture 5 Media. Really excited to have you here. We started the Emerging Manager Spotlight last year because we really saw a gap in terms of the programming that was available for emerging managers, both on the GP side as well as the LP side, and also the service provider side, because all of those groups need to work together really well to help get an emerging manager off the ground. So if we do a quick introduction of our speakers, I'm going to give a quick short one for myself, and then we'll jump to Chris, then Sabrina, then Matt. So for myself, I'm the founder of Venture 5 Media and the co-founder of Going VC. So Venture 5 Media, as you may know, we reach 50,000 founders, funders, operators, and allocators every month through the largest VC job board in the world, the series of newsletters that you're probably, or you might be familiar with, and live events and webinars like this. So really excited to continue what we've been doing for the last decade plus and educating the venture community. So with that, I would like to have Chris jump in and do a quick intro.
Yeah, thanks, John, and thanks for allowing me to sponsor this event. Um, I'm Chris Harvey, and I'm a emerging fund lawyer. Been practicing for about 15 years, and in venture capital, 10 of those. Over the past several years, we've kind of seen this space, the emerging fund space, really open up. And so 10 years ago, this didn't really exist. My job didn't exist, but I kind of saw a market space for it, a wide opportunity, especially around the pandemic times. And so pretty much all of our focus right now is on emerging funds. We primarily wear two hats. One is the fund formation, which is what we're going to talk about today. And then the other part of that is the venture deal space. Right now, it feels like those two are kind of competing, and we're seeing a lot more fund formations happen. And this is, I think, is very topical for today. So with that, I'll pass it over to my client, Serena.
Hey everyone, great to meet you. I am Sabrina, founding partner of Omni Ventures. We are the manufacturing tech VC. Really excited to be here and chat more about how it's our experience building a fund. One piece of information that might be helpful is my background is actually transitioning from the engineering operator side of things and forming a fund within the past 3 years. And so I don't have a traditional finance background, and it's been very important for me to surround myself with the right folks to understand how to navigate this industry very efficiently. So very happy to share as much learnings as I can on this podcast.
Great. Thanks a lot, Sabrina. Super excited to have you. And then last but not least, Matt. Matt has been in the LP community for a long time, so I'm excited to hear some of that in your introduction, Matt.
Absolutely. Thanks, John. Really, and thanks, Chris. Thanks for having me. As John mentioned, I've spent the last 20 plus years as an LP in a variety of institutions, large and small, representing family offices, individual capital, retail capital, as well as some of the largest institutions in the world. So started my career at Hamilton Lane Advisors back in the mid 2000s when it was a relatively small firm representing some of the largest pension plans and sovereign wealth funds in the world. Spent another 8 years at an outsourced CIO called Hurdle Callahan, where we were investing on behalf of small institutions, individuals, and families. And then spent some time at MetLife investing the balance sheet of the insurance company. So think of a Fortune 50 company investing into the asset class, probably one of the top 100 most active in the world. And then spent the last 3 years at a startup called Allocate, where we were investing exclusively in venture capital, trying to bring more LPs and more GPs into the ecosystem. So, all of those different roles have brought me to where I am today, where I now serve as a consultant for both LPs and GPs in this context. And what hopefully we can talk a little bit about today, I wear a hat where I advise emerging managers on their sort of go-to-market strategy with LPs, thinking about how to tell the best story and how to put yourself in the best position to hopefully close some commitments. So excited to share.
Fantastic. Thanks, Matt. And one last bit before we get going, I wanted to give Chris another shout out for supporting the Emerging Manager Spotlight through his firm, Harvey Esquire. Highly recommend that you follow his Law of VC Substack as well as LinkedIn. Even though he is a sponsor, I've been following him for years. So his stuff is top quality, top notch, especially as it pertains to the emerging manager space. So with that, let's dive in. So I'm going to start, Sabrina, with you, right? Because you are the emerging manager. Could you just give a quick 20-second summary of the fund in terms of like size of fund. I know obviously you focus on sort of the manufacturing tech side of the world, but just maybe a little more about the numbers would be, I
Yep.
think, helpful.
Absolutely. So we have raised a $25 million fund. We have decided that we're writing checks between 500K to around 1 million. We invest early stage, pre-seed, and seed. And all of these pieces have supported the underlying strategy that we have for our fund. And so I think maybe in a bit we'll talk about how we aligned on those numbers particularly. But one piece of advice just off the bat is making sure that that really aligns with your strengths as a GP and your underlying strategy as well.
Got it. And for you, so describe that for yourself, I think would be really helpful in terms of
Yeah,
that strength, and how does that tie? I think you said to the fund size, right? Is that,
totally.
yeah.
Yep. So given my background not coming from the world of VC, we have really built this fund from scratch. And so a little bit more on my background, I worked at Apple for a number of years, founded 2 startups, then we pulled together some of our angel investments and started formalizing our fund, and then launched an institutional fund, which is Omni Ventures. And this allowed us to have a very unique perspective on the industry that a lot of early stage VCs don't have. And so if you think of the typical financial VC that's been in the industry, playing in the generalist space for many years, it works fantastically for potentially general SaaS, for specific types of business models that have cookie cutter business models that you can really pattern match to. In manufacturing, it is very challenging to do that. We've found, especially having worked in the industry for 10 plus years, you really need to understand not just the right players in the space to talk to when launching a new business, but also like understanding the nuances of any particular problem that is seen in the industry. There's no one size fits all model, and it is a very established and antiquated industry, honestly. And so being, for example, a fresh out of college founder who has never worked in the space before, it's very challenging to find the right fit there. And so we really leaned into that inside of our fund creation and figuring out how we wanted to strategize our story to not just LPs, but to founders as well. We're trying to say that we have the industry experience. We understand where you're coming from. Given our, decades of experience at Apple, we have industry connections that we can connect you to and help accelerate you go from truly 0 to 1. And so that piece allowed us to understand we wanted to be a pre-seed investors because it is where our edge truly is. And we, given our experience, can divine product market fit before other VCs. Second, what fund size and model allows us to generate the best returns for our LPs, given that we want to get in a very early stage. So we took a look at the size of deals that we had seen through our angel investments, what valuations they were coming in at. We've been watching the market for a number of years, and have found that we can actually get into deals under a 10 million valuation. And the reason why I'm throwing out this number specifically is because this early ownership is our fund model. I think there's 2 different ways that you can kind of go about early stage venture. You can go very, spray and pray type bets, or you can go strong allocation into a certain number of smaller bets. And we opted for the latter because that really aligns with the edge that what we can provide to our startups. So I can go into like how that influenced our fund model and how we can go further, but maybe I'll pause there and kind of like open the floor for the questions.
Yeah, I actually want to jump to Matt.
Yeah.
Matt, when you see, a fund like this walk through the door, right? $25 million fund, very specific thesis and, a right to win. How do you look at this kind of fund as a fund one? Like what are the things that you would look pretty closely at versus say, fund 3, fund 4?
Yeah, it's a great question. And I think what Sabrina laid out is a blueprint for how a first-time fund needs to set up their thinking before they start going to market, right? It's this fund 0 idea. Generally, these are folks who are either in an operating role, have been angel investors, are within a larger firm. It's not a fully fledged firm yet until you close those first dollars. So thinking about that strategy up front, what makes sense? I always like this term of GP thesis fit, right? Is it the right person, the right strategy at the right time? So those are the components where you can control the right people and the right strategy. So we're looking for is this authentic to the skill set that you bring to the table? At Fund One, it's while there may be an angel track record, it's much less about historical performance and much more about the story and the person. So is this person uniquely qualified to do what they are trying to do? Is there a reason to exist? I think we joke about this a lot, but the world has a lot of venture funds. And if you look at what happened in 2021, 2020, and 2021, just a huge influx of new folks jumping into the market. So really understanding the entirety of the landscape, the thousands of other firms that are out there. So what is your unique insight? What is this reason to exist where you feel like, as Sabrina just described, there's a reason why her firm should exist because it can capitalize on a lot of those key pieces that make this GP story work so well. So those are the pieces that I would look at. And then obviously digging into the fund model, there's a mix between humility and ambition, right? You want to make sure as a first-time fund, it's hard out there to raise capital. I'm sure I'm preaching to the choir with a lot of folks in the audience here, but that is, you need to understand how to get that story out, how to be able to tell that, and how to raise the appropriate amount of capital to hopefully get through that fundraising process as efficiently as possible to then be able to go and execute the strategy. So yeah, it's a lot of story, a lot of qualitative assessment of who these people are, what they're trying to build. Does it make sense? Can it be successful? For that Fund One story, that's really where we spend most of our time.
So Chris, I want to bounce to you, build off what Matt said. So you know, at the very earliest stages before fund formation, right? You'll see like GPs sort of like dating, if you will, right? They might be trying to figure out the strategy. They don't have it completely nailed down yet. You know, being counsel to these, you know, these emerging funds, are there certain things that make sense to do very early on in sort of the fund formation and, you know, sort of, I guess I'll say planning process, for lack of a better term? Are there things that they should kind of knock out really early? And are there things that they should kind of push off until later? Is there any like order of operations that you think is really important?
Yeah, it's a good question. I saw someone a couple of weeks ago who just said, "Don't talk to a lawyer until you fully realize your fund limited partners." Because I guess someone got burned in their organization because they spent 50K on legal before they actually had a hard commit. So just taking that kind of like as a framework, you do want to talk to your service providers before you actually get the fund ready to go. And I think the important thing is really just getting around scope. For one, costs are a big thing, right? I mean, to raise the proper funds, I've heard people say that it takes $1 million of your own cash to raise a $50 million fund. I don't think that's true. But I do think you need to go out and figure out who are the key players, talk to them. Don't turn on the clock when you're talking to your lawyer. Make sure it's, you know, make sure you're just getting basically the scope, the costs, and the timing of how things take. And so I talked to a lot of emerging fund managers who have the core idea and they're kind of thinking about it. I rarely engage with those folks. We kind of need to have the answer to your question to make this succinctly is we kind of need to be engaged when you're ready to go to market, when you have the thesis solidified, when you have LPs, you know, tracking and you're ready to go out to market. That's usually when I get involved in terms of like the legal. But there may be several conversations spanning over years, in fact, where we've kind of bounced ideas off each other and I'm not turned on the clock and there's not an expectation of a bill. But yeah, I think the worst advice is to wait till the last minute to bring in legal or fund admin or all these other players.
Sabrina, how did that play out for you with your fund? You know, when did you sort of start, you know, getting the docs and signing things and all that sort of thing? Like, what was your order of operations for this Fund One?
Yeah, great question. There's been a huge amount of, I guess, first time learning with this fund, given the fact that we didn't come from a financial background. And we luckily met Chris early on in our journey. And there are so many different small decisions that need to be made at the start of creating a fund. And there are so many unknowns, I suppose, for us particularly, that you throw around the terms like, fund subscription docs and what should be on our term sheet. How early should we be showing that inside of a negotiation with an LP? uh, all of these peripheral things that when you don't come from the space, I think is really, really helpful to understand specific proof points. So the way that it worked for us was we first and foremost aligned on our thesis and try to understand, do we actually have an edge that is worth building a fund around? And I think ultimately that matters most. But once you define that, understanding actually the structure of your back office of your fund and understanding how to plug in your fundraise, on a day-to-day basis in with building out your strategy and maintaining your deal flow, all of those things need to be juggled simultaneously. And so I completely agree with Chris's point that waiting until the last minute could be actually quite detrimental because you're not thinking comprehensively about all the things that need to be balanced as you're creating a fund. So we actually engaged relatively early in our fundraise with a bunch of different service providers. Did our down selection to the core that truly helped us honestly beyond, like not just their title, beyond just specific legal advice, for example, kind of like more industry experience and industry knowledge, and found the right ones that could really help accelerate us. And we're so grateful we did that early on because it truly has allowed us to catch up and exceed our peers in the space way faster than we would have otherwise.
So maybe I can just follow on to that because I do think both being helpful to you, but also from an LP's perspective, I need to make sure that this fund is buttoned up enough to accept LP capital, right? And thinking about institutions, big institutions versus individuals versus all the different shapes and sizes of LPs, most LPs are going to need to see some baseline of legal representation, fund admin, audit, all the sort of things that go into fund investments. So not even is it getting the firm up and running and ready to go, but it's also the vote of confidence that, hey, if I do commit capital as an LP to this fund, I know it's going to work right. So we always look for one, are they present? Two, the quality of the folks that you're working with. To be able to give you the right advice, because particularly in the case where a lot of the firms I work with are new to the industry, right? They haven't come from it. They're not from a big firm, so understand how all the mechanics work. So having good advisors, as well as they can be the same people who are the service providers. So that's super important as you go through that journey as well.
There's a question from Karina, which is in the chat window that I'll bring up now because that's where my mind was as well. So in the startup world, raising money, and I've raised money for companies, I've advised companies that have raised money, portfolio companies, et cetera. And, most of them, right, it's not just like they start the raise, they end the raise, success, right? There's often bumps in the road, and even, you'll see kind of a market testing, right? And maybe just not clicking, pull back, rejigger a few things in the plan, the pitch, and then go back out. How do you think about that, Matt, in your world? And then also Chris, for you, because that, maybe affects the legal pieces too.
Yeah, I think I'm happy to share on that one. I think it's first the recognition that it is going to be a long process. I would say, even if you look at the median time, I think PitchBook or one of the big data providers puts out, even in the best of market, the median time from launch to final close is usually a year, right? And in the more recent times, we've seen 18, 24 months and beyond. So first, go in with the expectation, only for a select few established brand name firms are you going to be able to go up and down in a quarter or two, especially if you're starting out building those relationships, building top of funnel. That's going to take a lot of time. So what I would say is feel free to amend, to kind of tinker along the way, one with your go-to-market strategy, so to speak, from a fund perspective. The story should be the same. Like when you're launching, make sure you understand, again, back to that idea of fit, who you are, what you're doing, what you're uniquely qualified to do. But feel free to change that along the way, around the edges. I don't think if I met you 6 months ago and I meet you today, if those stories aren't identical, I'm going to think there's something, going on in the world that's a negative signal. So just, be responsive to what you're getting in the market, but don't change the essence of what you're trying to build, I guess would be the way that I'm seeing. There's also the dynamic that kind of a lot of folks, I think the adage is they're happy to be the first person to be second. So those early movers takes some time for people to get across the finish line. So recognize that there may be a groundswell the later you go, and as you're making investments, as LPs are able to see more in the portfolio, that may give them more confidence, particularly for a fund one, when it is just the story. You can show them rather than tell them.
Chris, for the new funds that are raising, do you tend to see it similar to the startup world where it's, sort of soft circling a bunch of like angel sized checks and then going out to get the bigger checks, or does it work differently in the fund world from what you've seen?
Yeah, I mean, I think it works a bit differently because the journey is so much longer. Whereas when you're raising for a specific series or trying to make that very finite, take a limited number of meetings. Um, I've heard strategies where the first time fund manager will speak to 1,000 LPs, right, and to see if anything will stick, right. I don't think it's a great strategy. I think you kind of have to be a little more focused today, only because the capital's a lot tighter, and if you don't focus your efforts, it will take, the averages are 18 to 24 months. But to Matt's point, I will say your the thing you're looking for the most is really your anchor, or to take that one signal to show that, hey, these are established players, these are people who know how to pick good investments. And it happens in all my funds. They struggle for the first period of time. That can be weeks, that can be months, that can be years. They get that one LP that sends a signal to the market, hey, we're putting in our dollars. A lot of times you don't know how many, it's not much. Sometimes it doesn't even need to be that much, but it's a signal that we're backing this emerging manager. And then after that, it's a light switch. Everything becomes easier, doors open. People said no in the beginning, take the call. And to an earlier point, I think that Matt raised as well, which is like, what are LPs really looking for? And I don't know this. I'm just a lawyer. I draft the documents, but seeing my clients sometimes go through this, you kind of pick up on things. And Benedict Langer the other day ran a poll for 50 active LPs, and he asked 3 questions, and these were really revealing. The first question he asked is, what do LPs want to determine on the first phone call with you? The second question is, do LPs prefer to walk through the deck on the first call? And the third one was, do LPs receive the pitch deck prior to the call? Okay, and the answers were very, very clear on what LPs' preferences are. So what do LPs want on the first call? And Matt nailed it. Is this GP a special person? Can they tell their story? Does it align with what they're going for, what they're targeting? 81% of LPs said, yeah, that's the first thing we need to find out. On number 2, it's don't send a deck, but don't try to walk them through with the captured audience to go over your talking points on a pitch deck. Just send them the pitch deck, let them receive it, and if the LP wants to, you can go on and discuss it. But strong preferences, 90% of LPs do not want to be on a pitch call for the first time with their potential investment in this GP, but they do want to have the pitch deck before that call. So these are the things that like these are small things. These are things that obviously Matt knows about. It's very hard to do this at scale because oftentimes you're going to fall on bad, the typical first time fund manager mistakes, which is you try to reach out to as many, you try to reach out to people who are not really in venture. Venture is a very, very super niche space. And what I tell even my clients is, if you're going to be an average investor, you're going to be average VC, don't get in this game. It is not for the average folks. It's for the special and something that the edge that someone is willing to buy on.
Sabrina, for you, in terms of working with those early LPs to get them over the line, curious, how important was the deck, right, in your journey? But also, are there any actionable tips that you saw worked across like multiple LPs, and sort of what was the like category of those LPs? Like, was it FOs or like partners at other VC firms? Anything around that you could share with the group here?
Totally. To start, the deck was very helpful at the beginning of our journey to help formalize our own pitch to ourselves. And I think that early iteration on the deck was incredibly important for us to understand the like tightness of our own story. So we started as you know, naive engineering operators saying like, we're smart, we're from Apple, we have all of these patents, you know, invest in us. And that is not a good story. It is not showing why you're going to be a good financial allocator. Being smart is completely different than being good at venture. And all aligning that strategy along with our true strengths was, I think, the key that flipped for us from, you know, pitching endlessly to finally getting those first couple conversions, uh, allowing us to reflect on the actual macro of the market right now and how that ties into manufacturing tech and why we are specifically the right people who have seen the industry for long enough to know how to pick those deals. Once we tied that story much tighter, that's what really changed the game for us from a fundraising standpoint. And we wouldn't, for us, it was very helpful to have a deck because, you know, people would give us feedback and say, you know, this slide is like hard to read, et cetera. But that's not the feedback that we were actually looking for. Eventually, we started getting feedback of, okay, this slide doesn't make sense with your story. And so we're now at the point, especially during the end of our fundraise, like we certainly don't run through the deck, particularly on first calls. We talk about our backgrounds, why we're passionate about the space, why the macro is pointing to the fact that this is going to give outsized returns in the next couple of years, and why we are the right people to plug into the space at this point in time. And so completely agree with the points that both Matt and Chris are making around success is not showing beautiful slides and saying we're smart, look at our slides. It's actually saying this is how we think about the market. This is why we are the right people to plug into the market at this point in time. And so as we were running through that, I guess the general tips that we had, it was very helpful to show our deck to a lot of, not LPs, but folks tangential to the industry that could give us feedback on, did our ideas make sense? Like, did it pass the sniff test of, do we actually have some competitive edge here? And as we proceeded down the line, we met with more people that had more experience in the venture and had more exposure to particularly emerging managers. And then we could see, did we actually stand out amongst those other decks? And was there something truly unique? And I think there's also a common misconception of, you know that you want to stand out. How actually do you do that appropriately? When we started, we considered having our check size be the thing that was interesting in our strategy around that. We wanted to, obviously, even from the get-go, we wanted to be first check-in. But our first strategy was to do 100K checks, kind of spray and pray those, and then follow on with $1 million checks for conviction. That strategy, after I finally did our fund financial return model, proved that that would not be a very good strategy for the market that we were trying to get into. Really, in pre-seed, the name of the game is getting high early ownership and getting targeted bets. Because of the way that we like to work with startups as well, we like to have a big piece in their acceleration. And we view that we can really help early emerging managers, early founders find product market fit very quickly, given our network, and help accelerate them to the seed or Series A faster than others. And so we actually changed our strategy to instead deploy larger checks at the onset because of the conviction that we're able to develop. And that is just better for our fund model. It's better for the founders. It's better for all parts of the ecosystem. So I think those are the types of things that we ran into at the start, and we kind of matured through our fundraise, through talking to more people, and really honed our message towards the end of our fundraise.
If I can jump in, Sabrina, I love the conversation around the deck, because that's usually when I meet a GP, that's the first thing they say, can you take a look at my deck? And while it is instructive, and I think the exercise of putting your thoughts on paper is really important, especially as you start out. The idea of a deck is to get you to that first conversation often. So many groups, one of the things that I see is they try to put the whole story on the page, and it just, there's a couple of stats that I always point out, some DocSend data of like how much time an LP spends looking at a deck. It's less than 2 minutes. So if you have a story, a written prose in that deck, it's probably not gonna land. The average words they say that the brain can consume per slide, if you do the math on that, it's about 37 words. So keep visuals, flow charts. The more you can make this graphical and pop, and that does help, to your point, Sabrina, of like standing out. If I'm looking at, as an LP, 10, 12, 15 decks a day that are coming inbound, I want something to be easy to consume, but also tell me the whole story. And then the third point of that is the what's on paper has to resonate then and follow through in the pitch. A lot of times I'll review materials and hear the pitch separately. And what I hear is a much more compelling pitch than what shows up in the deck. So really trying to bring the best, your best foot forward and really look at both of those pieces to be able to magnify and let that deck open the door and then really continue moving down the path through that first pitch. But it is such the deck itself is a lot of time and energy spent on every word in detail.
Thanks. Thanks, Matt. Chris, on the deck, I know it is not the thing that's going to get someone to yes, but I know just around marketing of funds, right? There's some rules around that. Is there any like mistakes that are super easy to avoid if you only knew what they were up front related to your deck or, kind of the marketing of your fund?
Absolutely. And I just did a post on this on LinkedIn. I'll share it with you, but there's kind of like a guide that we now have because of the marketing rule, which applies to RIAs. It's kind of this RIA is registered investment advisor. If you have a lot of AUM and you invest outside of venture, you're going to end up being an RIA, which requires a lot more strict rules. One of those rules are the marketing rule. So I put together a chart and I'll share it with you guys, but I'll just go over it real quick. But as I'm reviewing pitch decks, like I just reviewed a pitch deck that I told the GP, I was like, this is the top 5% of decks I've ever seen. But the legal landmines that were in this, like I had to tear it apart, unfortunately. But so like, things like when you're talking about performance and when you're talking about, the markups you have in your fund, you have to be pretty particular and have the evidence to back what you're presenting. So a few of the key rules or principles are you have to have a fair and balanced presentation. So if you highlight your secondary portfolio it's gone 10x and really it's just markups from safes, LP that's material information that LP should probably know about. If you're pulling in from personal investments and mixing it in with prior results, also a problem. The general rule on all this is just, no false or misleading statements. If you can follow that rule, then common sense wise, and you're fine. It gets a little, it's the gray areas, right? So you had one investment that 100x, you definitely want to put that on the deck. But you don't tell about what happened to your 50 other investments that went bust, right? Because that's not something that you want to shine on, but you're kind of presenting not a fair and balanced track record. And so right now, track record is really your lifeblood for going out to market because investors are looking for either people standing out. Track record is one way to stand out. And so being particular about, how to calculate TVPI, what's net TVPI, presenting them both together, also important. But in a broader sense, I think this is probably the question I get to ask the most, at least on Twitter or X, which is, you have a GP who goes out and blasts the community and says, hey, we're raising, or even more subtle, hey, we've put together this fund. These are our core investment strategy and et cetera, et cetera, et cetera. They don't give a link to sign up from their subdocs, but basically that's the only thing that's missing. And so there's kind of a visceral reaction from the rest of the GP community because everyone understands that, hey, this is supposed to be private. You're not supposed to go out there and publicly solicit. The answer to that is it depends on the fund manager, but by and large, the regulatory environment permits this. You just have to do a check the box 506C. If you're working with a fund admin, they're going to be checking these anyway. And for the most part, these headaches have kind of been removed from the system, as long as you have service providers that are giving you good advice. And the way the rules work today is essentially you have to be an accredited investor to invest into funds. There is a technicality. People don't realize this. You can actually have non-accredited investors that invest into venture capital funds legally. Never recommended because there are so much landmines there that the cost would outweigh any benefit you would get from it. So almost always you're just dealing with accredited investors that come into the fund. Once you have that, then whether it's public solicitation or you're doing it privately is really up to the fund manager. It's not a huge regulatory consideration.
One more question, and then we'll move to some Q&A as we see a lot in the chat window. So we want to get to some of those things. This one, Matt, maybe start with you. So when someone comes in like Sabrina, right, with, okay, here's fund one, here's what we're doing, here's, the strategy, here's why this is the right team, this is the right to win. Is that enough, or do you need to hear a bigger vision out of the gate where, I think about, I'll pick on YC for a minute, right? Like YC is, right, they started as the accelerator, but now, they got the growth fund, they've got, who knows what they have, right? They have like 5 or 6 different strategies that are all rolling up into that. Do you need to hear a big story, be it that, or be it like, hey, this is where this firm is going to be 20 years, or is it more just about, hey, the fund one story is just going to be tight?
Yeah, I think it varies by LP, but I think most LPs will say they want to invest in a firm rather than a fund. So the idea that there is the capability and the vision to build this into a franchise, right? And that could be, I want to raise $25 million now. I want to raise 25 million in 2 years. It doesn't have to be, we have to become the next big firm. But when you're pitching to LPs, that's something that I always think about. A fund one commitment, so long as you don't screw it up, I should be there for fund two. And then, this idea of, did you do what you told me you were going to do at fund two? So the idea is, we're underwriting fund one. I use this analogy. Everything that comes in the door is a default no. So you have to convince me to get over that hump. And that's why investing in fund ones is really challenging. But once you get over that hump, you're able to look at it from inside the 4 walls. You've done all the work. You've kind of unearthed some of those things that you're watching out for. So you're predisposed. I say it flips to a default yes. So long as you don't, there's idiosyncratic factors that could play into this, but so long as everything continues to move in the right direction, you want to continue to support that group. So it's incumbent on the GP to lay out at fund one what that vision is. If you are raising 25 million now and you want to be $1 billion firm in 3-4 funds, that may impact the decision of people investing in fund one. But by the same token, the transparency of that, you want to eliminate as many surprises as possible. So a long-winded way of saying, as long as it's an authentic story to what you're doing and what you're building, and you're clear about what the vision is, you're not locked into it because it's multiple years, maybe decades away. But I want to know that you have that thought. Like, if everything works out, what do we want to be doing in 20 years?
Got it. Sabrina, there's a question from Sterling about your team composition for your fund. What does that look like? And, how did you think about that as you were and when did you think about that, right? Was it when you had 0 raised or 20 raised, or how did that whole process look for you?
Yeah, we have 2 GPs, myself and my co-GP Simon, and a third founding venture partner named Lucas, who all of us met back in the Apple days and have thinking about this manufacturing tech thesis even since then. The roles and responsibilities that we've kind of figured out over time are, there's 3 basic buckets to creating a fund. There's the fundraising side of things, there's the back office side of things, the deal flow side of things. And so all of us enjoy different aspects of that. And we've kind of figured out between our team who can fit which areas. The most important thing, though, I think, when developing a core team of your fund is realizing it's going to be a 10+ year relationship with these guys. And one of the most this is exceptionally critical. Don't just launch in with a random person that you've met for, less than 6 months to propose to start a venture fund together. I think you really need to vet your working relationship and go through potentially relatively challenging scenarios before committing to this, relationship that may even be longer than some marriages, unfortunately. But that was luckily we had vetted our relationship through knowing each other for 10+ years. We know how we work well together. We have very different skill sets, if I'm being transparent, and I prefer to be more of a convergent thinker. Simon is a very divergent thinker. Because we disagree often, it actually allows us to when we do agree, we realize we're probably going in a good direction somehow. And so I'd say finding folks that, challenge you in a good way is very critical to that founding team.
Chris, how have you seen that in your world? And I don't know, it'd be helpful to know, if let's say you have 2 GPs, are they both, jumping on the calls with you and both super involved? Does one typically take the lead? Like, how does that all work? And how have you seen partnerships, really be built and then, kind of stay strong?
All right, so this is so it's a relationship game, which means that these are always idiosyncratic. They're always unique to the individuals, to the culture. Um, I do think, having time with the fund manager is always a good bet because it builds trust, and ultimately that's what you're selling to your LPs is trust. So if there's any daylight between the GPs, I mean, there always will be daylight, but if there's any major fundamental issues between the GPs, and by the way, this is a long-term game, right? So 10, 12 plus years, you're going to be with this person. Obviously some of the tired analogies are to marriage, because the quip is that you're married longer to your GP than you are your spouse on average. And so, these are long-term relationships, and, fundamentally it's about trusting the other person. I think that's where all this stems from. I do think going through and having the proper procedures for deadlocks or for, things that can go awry are good, if nothing else, to understand what the process is if things are fundamentally broken. And usually I just say, look, I mean, we don't even need an L or a GP agreement as long as the GPs are adults and can work it amongst themselves. But quite often we need to have those in place just to level set and make sure that that everyone can play nice and work through the issues, which there will be. There always are.
What are the top two or three that if I'm, thinking about, hey, I'm going to raise a fund, but I think I need a partner or two partners or whatever the case may be. What are a couple things to kind of think about before you go to your lawyer and have them start, papering things up? Like, what conversations do you need to have, and what do you need to think about for yourself in terms of like, what do you want?
Yeah, exactly. Yeah. So first one is just obviously split of voting control. So is one partner going to be leading the decisions and deferring to the other partner, for where necessary? Are you going to split up some of these like higher level decisions for if you're investing? Do you want unanimous consent, or can one person have a tie break? And then also economics. That's what drives a lot of these issues are economics, because even with a equal split, someone may always feel slighted in saying, "Hey, I brought in 80% of the LPs, and you only brought in 20%, so therefore I should be getting 80% of the economics." But when there is shared, when there's shared vision, and so the other person maybe is not out there with the LPs, but working on the thesis, bring in pipeline deals through the pipeline. There's just different skill sets. So understanding the splits, it's very similar to what like startups go through, because these are very foundational issues. So the blueprint for startups, actually, a lot of that does apply to fund managers. The only difference is you're very rarely starting a fund with five fund managers. It's often one or two, and sometimes three. And so the dynamics are obviously very more intrapersonal, and understanding, that you need to have some sort of release valve if users become a little bit more, I'd say a little bit more heavy than your typical startups. So yeah, I mean, I'd say, look, this comes up often. I can't tell you how many times I thought, oh, these two will never have an issue. Something happens, LP leaves or something, fundamentally changes, and then it's just, what do we do? And it always go back to, well, what did we put in the opera agreement? That's the blueprint we go off of.
Yeah, and I think if you're, to your point, Sabrina, about it being like a 10-year type of situation, things are bound to change, right, in a 10-year period. And so, yeah, how do you navigate that as partners kind of going in that that, maybe there's a major life change for one of the partners, or a change in, sort of enthusiasm level, or whatever the case may be. So yeah, it's, I'm kind of amazed that there are so many partnerships, given how, sort of hard it is to find the right partner and then, be able to actually get to an agreement with them. So, Sabrina, one more question for you. I was just thinking, in the emerging manager community, I know there's a lot of private WhatsApp groups where, emerging GPs will kind of hang out and, swap notes and that sort of thing. When you're building your firm, aside from, and I don't know if you would even put these as firms you look up to, but, putting aside like the sort of like tier ones, are there folks who are like a little less on the radar that are emerging, where you're like, you kind of are like, yeah, I would really love to, you know, what they're doing is really good in terms of how they're building their firm, and folks that you kind of really keep an eye on and see what they're doing. Maybe not to copy them, but just, you know, to kind of learn from how they do business.
Yeah, we actually have a couple of those communities ourselves and have started a few, and it's been incredibly helpful, honestly, to have a network of peers that we can really share learnings with. Some of the highlights that are emerging or kind of playing in the same area as us. We really like Hustle Funds. They're not really a secret at this point. Their online presence is incredible, and they have so much free information that they share regularly on their YouTube, on their Twitters. So really, really like them. Another fund that has been incredibly helpful to us, they aren't emerging, but they are playing early stage, is 10VC. Ben Patterson is fantastic and has been a huge mentor for us as we've been growing. And the things that really stand out for, I think, each of these funds is their thoughtfulness around their strategies and what they're bringing to the table in terms of how they're addressing the industries. Hustle Fund is a generalist early stage fund. They have a complete openness around, like, you know, how they structure their deck. I think they've even shared their deck in a recent video that they had, I think, last Q3, and how they talk to LPs, what their pitch sketch looks like, how they maintain tight relationships, because really this is a huge relationship game during the early fundraise, and certainly as you're working with your portfolio companies. So I think they execute that and share learnings around that very well. And then on the other side, Ben is very curated relationships, sort of smaller niche fund where he also develops very strong relationships with each of the portfolio companies. And I think one key strategy about the funds that have excelled, at least on the emerging manager side in the early stage, is that they are incredibly collaborative, which is, I think, is relatively unique compared to funds that are kind of later stage and playing the A plus game. Funds that are in the pre-seed, it is hugely advantageous for us to be collaborative. And if you find, because at this point, given the macro, I think there's a huge resurgence of very niche funds. I think the Generalist fund had its heyday, you know, probably like 5-ish years ago. It's very, very popular and the one that got funded well. At this point, because there are so many GPs, it's incredibly challenging to back just a new generalist VC, because what edge do they really have? And so finding folks that are diverse from your specific thesis, but playing in similar spaces or even complete different spaces but similar strategies, I think it's very helpful for all of us to kind of understand how we each fit into the ecosystem. And it allows us also to recommend LPs to each other that are actually high quality fit. I think new folks to the industry may think, oh, just give me a list of LPs and I can churn through them and like give my pitch to all of them, and you know that's going to work out well for me. It will not. Find people that actually understand like what they're looking for, right? Everyone has a specific perspective on the market. They're looking for specific things. And so being a part of these communities, I think, is incredibly helpful. In fact, on the chat thread, I've seen Coolwater mentioned a few times, fantastic program for finding GPs that are emerging, and also allows you to see the diversity of funds that exist right now and how you can be truly different and from everyone else. I think it's all of that is very important. Highly recommend just get your message out there as much as possible.
Matt, to build on what Sabrina said, how do you think about someone who comes in to pitch you a generalist fund versus a thesis specific? And this is something I struggle with too, where I think like logically, when you look at a fund, you're like, okay, they're very specific to this sector. They have a right to win in this sector. But then you look, I'll pick, you know, maybe the best example of this, and there are probably others, but you look at a lowercase capital, right? Lowercase capital, I think fund one was, I don't know, it was like, it was crazy, right? And that was definitely pure generalist, right? So how do you think about that as an LP in this market? And let's just also add another filter on it, which is like people spinning out of the bigger firms. Let's forget about them for a moment and let's look at just someone who, for whatever reason, thinks generalist is a good strategy for them.
Yeah, I think Muhammad Ali gets the credit for its different strokes for different folks, right? So it's the LP fit is this pre-qualification Sabrina's comment about getting into groups that actually understand. There's a challenge with a specialist versus a generalist, because think about a specialist. If you don't have someone who's already bought into the area of focus that you're in, whether that be a geography, how deep within a sector or an industry you want to go, you have to sell them on why that market is important first. I work with a group that focuses on mental health. And I think universally we can all agree that mental health is something that we could spend more time and dollars on. But you do have to spend time educating people around that industry if it's not second nature, where the generalist can avoid that. But there's that other filter then that Sabrina just mentioned, like how do you differentiate? What is the difference that you're doing at the pre-seed? I do think I saw in one of the comments in the chat, it was fairly network based, right? In terms of who you know, what you can see. I think it's more than that in terms of what you can do and bring to the table as a generalist. There could be, a group that has a background in coaching, in talent development, in certain pockets. So maybe it's not a sector focus or a geo focus, but it's a particular skill that they're bringing to the table. So I think specialist generalist might be a level too high, but is there this unique edge that's coming from your fund? It could be any of those components, but just saying like, hey, you're a generalist, it maybe loses some of the nuance of the conversation.
Yeah, I also will see what I call the we try harder thesis. Like we're always there, we answer the phone first, et cetera, which I would kind of put in that generalist bucket. It's funny you mentioned Sabrina Hustle Fund too. I have a ton of respect for them. They built an awesome brand. To your point, they are generalists, and yeah, it's just been interesting to watch them. I think they built a really great brand, and I'm actually going to their Hustle camp in May, which I'm like very excited about because it looks super fun. So I don't even know what I'm getting into, but I just like they look cool, so I'm going to do it this year. I wanted to do it last year, but anyway. I want to let folks go since give you a few minutes back. And I wanted to thank our amazing panel. So Chris Harvey, Sabrina, and Matt for joining us and for being part of the Emerging Manager Spotlight. Thanks so much.